Hey everyone, my name is Sharang Nadkarni, and welcome back to another episode of Finance with Sharang. Today we're discussing the greater fool theory, which is a concept that describes the behavior of investors who purchase overvalued assets with the expectation that they can later sell them at an even higher price to a greater fool. Essentially, it's a belief that as long as there's someone willing to pay a higher price for an asset, there's profit to be made, regardless of the underlying fundamentals or intrinsic value of the asset. The greater fool theory is particularly relevant in speculative markets, where asset prices are driven more by investor sentiment, hype, and speculation rather than underlying economic fundamentals. This behavior can be observed in various asset classes, including stocks, real estate, cryptocurrencies, and collectibles. One classic example of the greater fool theory is the dot-com bubble of the late 1990s. During this period, investors poured money into internet-based companies with little regard for their earnings potential or business fundamentals. Many of these companies had sky-high valuations based on expectations of future growth, but ultimately, the bubble burst, and investors who bought at inflated prices suffered significant losses. Similarly, in the real estate market, the greater fool theory can manifest when investors purchase properties at inflated prices with the expectation that they can sell them at an even higher price in the future. This behavior contributed to the housing bubble leading up to the 2008 financial crisis, where rampant speculation and lax lending standards fueled a surge in home prices that ultimately proved unsustainable. In the context of cryptocurrencies, the greater fool theory has been cited as a driving force behind speculative bubbles and price volatility. Investors may purchase cryptocurrencies with little understanding of their underlying technology or utility solely because they believe they can sell them at a higher price to someone else in the future. While the greater fool theory can potentially result in short-term gains for early investors, it also poses significant risks. When market sentiment shifts and the pool of greater fools dwindles, asset prices can plummet, leading to steep losses for latecomers caught holding overvalued assets. Ultimately, the greater fool theory serves as a cautionary tale about the dangers of speculation and irrational exuberance in financial markets. It underscores the importance of conducting thorough due diligence, investing based on fundamentals rather than speculation, and maintaining a disciplined approach to risk management. As the saying goes, the market can stay irrational longer than you can stay solvent.